3 days ago, Apple briefly became a $5 trillion company. $5 trillion. Then Apple reported the strongest June quarter in its history. Revenue climbed above $109 billion. iPhone sales jumped. Earnings beat expectations. Apple was selling more devices, making more money, and reaching more customers. And Wall Street's response was, sell. Before the market opened, Apple shares were down more than 7%, putting roughly $361 billion of market value at risk if that decline held. So, what happened? How does a company deliver record results and still disappoint investors? The answer is not that people suddenly stopped buying iPhones. The answer is more unsettling. The artificial intelligence boom is colliding with the physical limits of the real world, and even Apple may not be powerful enough to escape it. For most of us, a computer chip is almost invisible. It is a dark square hidden inside a phone, a laptop, a car, or a server. But the global economy now rests on these tiny pieces of silicon, and they are not made like ordinary products. A modern chip factory, known as a fab, is one of the most complex industrial systems humans have ever built. It can cost tens of billions of dollars. Its clean rooms must be protected from particles so small that a single speck of dust can damage the manufacturing process. The most sophisticated chips require hundreds of precisely controlled steps. And here is the crucial point. You cannot respond to a shortage by simply opening another factory next month. A chip fab is not a warehouse you can restock by Friday. It can take years to design, finance, build, equip, and test new capacity. Demand can explode in weeks. Supply may need years to catch up. Now add artificial intelligence. Training and operating advanced AI systems requires enormous computing power. Data centers may contain tens of thousands of specialized accelerators connected to high-speed memory, networking equipment, cooling systems, and power infrastructure. The chip is only the beginning. Every AI accelerator needs memory. It needs electricity. It needs a building. It needs cooling. It needs technicians. It needs access to a power grid that may already be under pressure. This is why the AI boom is not just a software story. It is an industrial story, an energy story, and now, an Apple story. Apple does not necessarily use the exact same chips that power the largest AI data centers. That distinction matters. An iPhone processor is designed for a phone. An AI accelerator is designed for massive parallel computing. But both depend on overlapping parts of the same semiconductor ecosystem. Advanced manufacturing, scarce memory, sophisticated packaging, specialized machinery, and a limited number of trusted suppliers. When Microsoft, Amazon, Google, Meta, NVIDIA, and AI laboratories compete for more computing capacity, they place pressure on that entire system. Memory producers redirect investment toward AI servers. Equipment becomes harder to obtain. Costs rise. Delivery schedules stretch. And companies that once seemed too large to face shortages discover that size does not create more hours in a factory. So why is Apple especially exposed? Because Apple still depends on shipping physical products at extraordinary scale. A cloud company can sell access to scarce computing capacity. Apple must secure components, assemble devices, move them across oceans, place them in stores, and persuade consumers to pay the final price. If one essential component is missing, the entire device may remain unfinished. A $1,000 phone can be delayed by a part representing only a small fraction of its cost. That is the brutal logic of manufacturing. A product is not 99% complete. It is either ready to sell, or it is inventory waiting for one missing piece. Apple's latest quarter looked excellent in the rearview mirror. Revenue rose 16% from a year earlier to roughly $109.4 billion. Earnings per share rose 29%. iPhone revenue reached more than $54 billion, the strongest third-quarter result in the product's history. Those are not the numbers of a collapsing company, not even close. But the stock market is not a museum. Investors do not pay mainly for what a company achieved yesterday. They pay for what they believe it can earn tomorrow. And Apple's forecast suggested that supply constraints would limit growth in the coming quarter. Wall Street expected roughly 12% revenue growth. Apple guided investors toward 9 to 11%. To an ordinary person, the difference between 11 and 12 may sound trivial. On Wall Street, 1 percentage point attached to a company worth trillions is not trivial. It can move hundreds of billions. Apple did not need to fail. It only needed to be slightly less extraordinary than investors had already assumed. Expectations were the product. And Apple missed the price. There is another reason this moment matters. During the same earnings season, investors sent a very different message to companies selling AI infrastructure. Microsoft added roughly $450 billion in market value in a single day, after strong cloud results persuaded investors that its AI spending was producing growth. Amazon was on track to add around $300 billion after its cloud business grew 37%. And management said customer demand was still greater than available computing capacity. Think about that contrast. Microsoft and Amazon are being rewarded because scarcity allows them to sell more cloud computing. Apple is being punished because scarcity may prevent it from building enough devices. The same AI boom, the same semiconductor ecosystem. Completely different financial outcome. This is not simply a technology race. It is a race to control the bottleneck. During a gold rush, the winners are not always the people searching for gold. Sometimes they are the people selling tools, transportation, land, or access. In the AI economy, the scarce layer may be advanced manufacturing, high-bandwidth memory, networking equipment, data center capacity, electricity, and cooling. Software receives most of the attention because software is visible. But the physical system beneath it may capture much of the money, and the warning signs are getting louder. The chief executive of SK Hynix, one of the world's largest memory manufacturers, has warned that the industry could face its worst-ever supply shortage in 2027, and that customer demand may remain above supply capacity beyond 2030. That is a forecast, not a certainty. Chip markets are cyclical. Shortages can become gluts. High prices encourage investment. New technology can reduce the hardware required. But new factories cannot be summoned by optimism. They require land, water, electricity, specialized equipment, rare technical skills, and time. For Apple, there are several ways out. It can sign longer-term supply agreements, diversify suppliers, redesign products, delay certain models, pay more, or pass some of those costs to customers. Each option has a price. New suppliers introduce quality risks. Redesigning products takes time. Delays surrender sales. Paying more compresses margins. Raising prices tests customer loyalty. Apple has spent decades building one of the most disciplined supply chains in corporate history. It negotiates at enormous scale. It designs many of its own chips. It can commit billions of dollars years in advance. But none of that changes the fundamental equation. When global demand for advanced computing rises faster than the world can manufacture it, someone has to wait. And sometimes, the company waiting is Apple. There is an important correction to make here. This does not mean Apple is doomed. Supply constraints can delay revenue rather than destroy it. A customer who cannot buy a new iPhone in September may still buy it in October. Apple's customer base remains enormous. Demand appears strong. Its brand gives it unusual power to raise prices. And the $361 billion figure was not money leaving Apple's bank account. It was the amount of market value at risk if the pre-market decline continued. Market capitalization moves because it reflects expectations, fear, positioning, and the price of the last shares traded. But those expectations still matter. They influence executive decisions, employee compensation, acquisitions, and a company's financial power. For years, the market rewarded almost any company that could attach the letters A and I to its future. That era is changing. Investors are becoming more selective. They are asking a harder question. Not, are you using AI, but where is the money? Microsoft can point to cloud growth. Amazon can point to computing capacity reserved years in advance. Chip and memory producers can point to demand exceeding supply. Apple must show that it can secure enough components, protect its margins, raise prices carefully, and turn its own AI products into a reason for customers to upgrade. The market is no longer rewarding the AI story. It is rewarding control over the AI economy. 3 days ago, Apple briefly crossed $5 trillion in market value. Then, one forecast reminded investors that even a $5 trillion company depends on factories, memory, electricity, machines, and time. That may be the deepest lesson of the AI boom. Artificial intelligence feels weightless. It arrives through a screen. It speaks in seconds. It creates the illusion that the future is made entirely of code. But underneath every answer generated by AI, there is a physical machine. Underneath that machine, there is a chip. Underneath that chip, there is a factory. And underneath that factory, there are limits. The most valuable resource in the age of artificial intelligence may not be intelligence. It may be the ability to manufacture the world that intelligence requires. And right now, even Apple may not have enough of it.